Good morning, everyone. Welcome to this update for global stocks and commodities for the 7th of October. Uh, I guess there was a fairly significant event during the week. The media is making a lot more out of it than what it deserves at this stage, but that's what happens. So there's no question that there was a significant inflection point in the markets, particularly in the bond markets through the week, with a breakout, as we'll see in the 10-year bond yield. Now, as always happens, the commentators are jumping on this and they're assuming that now that we've got a breakout, that markets are going to quickly march to a higher level of interest rates, and that's going to be really bad for stocks. So in this edition, I just want to have a look at the reality of what's actually happened, and just try and put a bit of sense to some of the commentary that you might be observing at the moment. So there's no question that last week was significant, but what will be the impact on stock prices? And my firm view at the moment is that, pardon me, it's way too premature to be thinking about a significant downward move in stocks. So that's what I'm going to have a look at. What does it mean for stock prices? We'll have a look at the normal stock and commodity updates as well. And in Portfolio Analyst last week, as I indicated, I would be looking at Australian resource stocks, because that is, I guess we're now getting to the part of the economic cycle when resources do start to do better, and also looked at the US energy scene as well, with the oil price breaking upwards as well. So it was quite a good session last week. Now let's look at interest rates. The rise that we're now getting off the all-time lows coming out of the GFC. This rise is normal. It's been expected. It had to happen. So there really shouldn't be any surprises. But because the market has paused around the 3% on the 10-year US bond yield for a few months, then when it breaks above that, the market tends to go into a bit of a tailspin that's pretty unwarranted, in my opinion. And history shows that stocks can move higher for several years. Now, a lot of people still trot out this old rubbish that once interest rates start moving up, that it's all over for stocks. Well, that's just actually completely factually false. On average, it takes around about 2 to 2.5 years before stock markets tend to reach a peak, and it can be as long as 4 years. And what we're seeing these days, of course, is that this level of stimulation that we've had and easy money policy has really extended everything in duration. So I don't think anyone can feel confident about when the peak in the stock market may come along. So what to watch for from index patterns, I think, is really important. And we're going to take a look at this. I've done that exercise many times before, looking at how markets appeared running into the 2000 peak and then running into the 2008 peak. So it's worthwhile to revisit that one at this time. And also I want to look at, there's a number of indicators that I follow, but I want to look at three important ones that I think will give you some factual evidence about what's actually going on. So, look, ultimately, this inflection point in the market will lead to a major top in markets. But as I said earlier, it's more likely to be at least a couple of years away yet, and could be significantly longer. We really need the 10-year yield above 4%, and probably closer to 5%. Is more like the area where returns from stocks becomes less attractive, and that's what causes a peak in the stock market. It's not just because interest rates go up; it's because fixed interest starts to become more attractive relative to the yield from stocks. There's nothing mystical about it, and generally, at that same point, stocks have probably had some sort of blow-off phase. Some sort of euphoria where everybody's jumped on the bandwagon. There's not that many buyers left. Stock values are trading at excessive valuations, and that's what causes stock prices to go down. So it's a bit simplistic to think that just because the the 10-year bond rate moves up a bit, that it's all over for stocks. And we haven't had that blow-off euphoria stage at all, and that is what marks the end of almost every bull market. But I do expect volatility will pick up. I think that's probably likely. So anyway, coming back to the three of the key indicators that I want to highlight today: the 10-year bond rate, the price of low-quality credit, which we can look at via an ETF called HYG. And there's no question that risk has been disastrously mispriced for a decade. So we had to have a period of readjustment. But as you'll see from the chart, there's really not that much of a sign that it's actually started yet. And it's worthwhile paying more attention to what happens in the bond market, because participants in the bond market are professionals, and they don't tend to panic and overreact, where a lot of participants in the stock market are not professionals, and they do tend to have periods of panic and overreaction. So it's much better, rather than listening to some commentator's view of what he thinks is going to happen, is to actually just look at what is happening in the bond market. Look at the high quality end of the bond market. So that's government securities and corporates that have the highest credit rating, and also look at the low end of the risk side of thing, or the high end of risk. So the low quality end of the risk market, and just see what's happening. And what you tend to see when things start to get a bit nasty is that you'll get a widening spread between the high end and the low quality end of the debt market. And extraordinarily, at the moment, the low quality end is actually doing better. The spread is actually closing, not widening. Now, I can assure you, if the professional market participants were starting to think that this was going to be a significant problem in the bond market, they would be selling off the low quality debt like there was no tomorrow. It'd be plunging. So let's jump in and look at some charts, and we'll start first of all. So this is TNX. So this is the 10-year US Treasury on a weekly chart. The peak right back here is in 1981. And of course, that's when interest rates were around 15–16%. If you've been in the market for a fair while, then you will remember those days. If you've had a mortgage for a fair while, you'll remember those days. So you can see we came down from around 16%, and we came all the way down to about 1.4%, formed a really nice double bottom here over a period of about 4 years. So this is pretty big picture stuff. So we formed a double bottom base at 1.4% interest, and now we have gone up to 3.2% interest. And as you can see, we've just broken out of that basing phase. But that is a 6-year base that's been in formation there. So let's just tighten in and take a look. So there's no question that interest rates are on the move. And last week, as you can see, was quite a decent week. We haven't had a move like that since way back here, which was in November of 2016. And of course, that was when the election of Trump occurred. So there's no question this was a significant move. And that's why the title of this session today, this video, is that markets are at an inflection point. This is a change, there's no question about it, but is it a change that's going to worry stock prices? My view at the moment is no, it's not. So we've got to get up into this area. I believe we've got to get up into this sort of area for on interest rates to be a bit of an issue for stocks, and we're a long way short of that yet. And of course, if interest rates start to move up too quickly, the Fed can always backtrack. So there's no certainty. In fact, there's probably little likelihood that interest rates are just going to go straight from here to there. Let's look now at the high risk end or the low quality end, whichever way you want to look at it, of the bond market, and this is HYG. So this is these are smaller companies that issue what are called junk bonds, and you can see that the price of HYG, yes, it fell last week, which means that yields are rising. So bond prices go down means yields go up. They go in the opposite direction. But let's just get a real perspective here. This was coming out of the upheaval we had in early 2016. So when you pan back and put it into context, it's really nothing much at all at this stage. And the final thing that I want to look at is this relative comparison chart. Now this shows TLT, which is the 20-year Treasury bonds. So this is the highest quality end. So it's a basket of Treasury bonds issued by the government, so the lowest risk, and that's the green line. And then the blue line is HYG, and I've taken them back 3 years. So we're looking at a 3-year comparison here, starting from the same point. And you can see that at various stages, they've reversed order in terms of their relativity to each other. But just at the moment, you can see that we've actually had a greater sell-off in the high quality end of the bond market than we have in the low quality end of the bond market. And that tells me that the professionals aren't worried, that this is something being played out in the media, and it's being played out by some less experienced players in the stock market. So that's why I'm not too concerned about this breakout in interest rates. So just whatever you read, put that into context of what I've just shown you. Now let's just finally look at the S&P, and I want to pan back and take a look at what we need to see in the stock market for it to be a sign of a major top. So throughout 2005, we dipped below the red line, the 200-day moving average. We dipped below it again in 2006, and then we had a dip in early 2007, but it didn't get to the 200-day moving average. And then we got a more significant move down, and that started in July of 2007. So this is more than a year ahead of the worst of the GFC market crash. So don't ever worry that you're going to get caught out by the next market peak. This was fully 12 to 14 months ahead of the GFC crash. Now, this put us on alert, I guess, that the market may have been changing character, because this was a bigger move. It went further below the 200-day moving average than what we'd seen here or here, and it was more volatile. The candle ranges were much, much bigger. However, this still could have been another one of these where we had a dip and then we went on and we formed higher highs in a renewed uptrend. So at this stage, you don't know, but at least it puts you on alert. Now, we got a sharp rebound in October of 2007, which sort of blows a hole in the theory that October is often a weak month, and formed a new high. And then we started to come down again fairly quickly. And again, you can see it's pretty volatile, lots of big ranges. So by the time we get to here, which is December, we're starting to get lower highs, 1, 2, 3. So we've got a series of lower highs, and we're also getting lower lows as well. And that was confirmed in January of 2008. So again, we're still 8-9 months prior to the major fall. So by this stage, you're on full alert that we've got a major market top and that you really need to be taking evasive action. So remember that this is the first warning sign. We then almost always get a rebound, and then you get subsequent confirmation. And this whole process generally takes many, many months. So you've got plenty of time to readjust. Now let's come forward to where we are now and ask yourself, are we seeing anything at all that looks remotely like what we just looked at before. Now, yes, we got some volatility in February, but we didn't even break the 200-day moving average. And it settled down fairly quickly, and we've gone on into a new uptrend. So for me, that was just a wobble that was brought about because this pricing here in January just got so far ahead of the moving average that we got an overreaction. So we got a burst up, and then we got a sudden plunge to bring it all back into equilibrium. But if you look at the trend line through 2007, we're really still just on trend with the trend that we had, which was a nice, smooth, stable trend in 2017. So I don't think there's any dramas with this at all. And I did write last week that markets were extended, they were overbought, and we would probably see some sort of mild pullback, and that's exactly what we got. And you can see that the candles on the S&P did finish off their lows on Thursday and Friday, so clearly there's still buyers coming into the market. All right, let's just quickly look at some of the other key indices. This is QQQ, which is the ETF covering the NASDAQ. The NASDAQ did perform worse than the S&P. There was some added selling in the FANG stocks, and you can see quite elevated volumes on Thursday and Friday. So there's definitely some adjustment happening in the NASDAQ, and that fell by about 3 times what the S&P did. So a lot around tech stocks. But again, you'll notice some nice tails on these candles. So that's really indicating that there was buyers coming in at the end. The other index to experience some selling was the Russell, and the Russell for small caps has been sold off to a degree. I think I read this as a lot about the trade tariff situation. The the Russell was outperforming the other indices throughout this year, and I think that was largely because people were shunning the bigger companies that had international exposure and therefore could be affected by the trade tariffs in favour of the domestic US companies, which tend to be more in the Russell. Now that we've seen resolution of the trades issue with Mexico and with Canada, and people are getting a little less worried about what's happening with China, then the focus has gone back on some of the bigger international stocks, and money has been coming out of the smaller stocks. And I think that's all that's happening here, because the earnings growth amongst the smaller stocks is still very strong. So no particular dramas there from my point of view. But just on trade management, so what can we do? I'm going through all this because it really dictates how we should act in the market. Now, I'm making the assumption that from here on in, markets are going to be nervous, interest rates are going to do whatever they're going to do, and people are going to get progressively more and more nervous, and markets will get more and more volatile as the years progress. But by no means am I signalling that we're anywhere near a major market top. There are just no signs of it. But I am assuming that volatility will pick up. And there's been an awful lot of stocks that have gone up very substantially and are now trading on, somewhat excessive PE multiples, both in America and in Australia. We've had some of the real high flyers in Australia are trading on PEs between 50 and 150. Now, that makes them, when you get into a more nervous, volatile market, that makes them more risky. So from my point of view, my focus is now starting to turn to where I can get exposure with less downside risk while still retaining the upside risk, and with likely smaller responses to volatility. So I'm focusing on sectors that have got large tailwinds, ideally due to unstoppable demographic or social drivers. Obviously, the social drivers come into technology, how we pay for things, how we get our entertainment, all that sort of stuff. The use of artificial intelligence, they're all part of the social drivers. But the demographic side, of course, you've really got to look at food, clean water, as the population on the planet increases. There's going to be an increasing emphasis on food and clean water, mineral resources, of course, and naturally healthcare. So they're the sectors that are going to have the large tailwinds. The next thing then is when to buy. Now, ideally, you want to buy into a sector when it's out of favour and it's emerging from a major base. That's the Warren Buffett way of doing things, and there's absolutely nothing wrong with doing that. If, however, something is already trending, a sector's already trending, then wait for a bit of a meaningful reaccumulation range and stage your entry there. And I do a lot of this in Portfolio Analyst. It's really identifying accumulation and reaccumulation phases and then letting those play out for a while and then identifying when the markup phase starts. So when the prices are starting to make their move out of that sideways zone. And so a lot of focus in Portfolio Analyst on that. All right, so the S&P was net, it was down 29 points for the week. And what I wrote last week was that more short-term weakness was likely, and I think some added short-term weakness is now pretty highly likely over the next week. It won't just suddenly stop with the 2 down days that we had. So expect a little bit of weakness next week. I've looked at what a major top looks like. So, there's just no sign of that at the moment. All I'm seeing that's happening is that money is rotating from some parts of the market to other parts of the market just to help work off some of the excess that those former leaders had built up. And this is just a normal reversion to the mean process. There's nothing unusual here. There's no change of character. It's just some of the excesses are being rotated off. US dollar gain for the 3rd successive week. So let's just take a look at that. So a bit of bouncing around, certainly over the last 2 months, but we've been heading back up again over the last 3 weeks, and of course that has had the impact on the Australian dollar of really sending it down. We closed the week at 70.43, so getting very close to that 70 level. But really, there's no support there at 70. The support comes in at 68.5. So we potentially could fall another 2 cents before we encounter some meaningful support. Just while I'm here, let's just look at the ASX 200 for the record. We were down slightly. But as I've said many times before, I don't place too much stock in what the ASX 200 is doing. So we dropped down to 70.43, and you would have noticed from that chart that the Australian dollar fell by a lot more than the US dollar went up. So clearly global markets are selling the Aussie off to a greater extent than just the currency effect. So our index was down by 22. I think it's definitely too premature to be going defensive, as I've been reading over the last few weeks. A lot of commentators saying, go defensive. I do agree that you probably need to, give a bit of a, miss to some of the really high PE stocks. But to be going defensive, to go to stocks that are ex-growth, it's way too premature to be doing that. I'm looking and have identified quite a number of stocks that have still got really strong growth rates, but they're trading on relatively low PEs and PEG ratios. Now, they're very hard to find, and most of them are quite small. Most of them are sub 200 million market cap. There's a few bigger ones in there that are representing some really good value at the moment, but it's an area that requires one heck of a lot of research, and I have identified a dozen or so stocks that fit into that category. So I've got high hopes for those. And of course, there are some other businesses that are trading on a high PE, but because they're businesses with very high scalability and therefore they can grow without the need for much additional capital investment in the business, what you end up with are companies that have the ability to produce very outsized returns on capital. And that's one of the things that really drives the stock price. If you can get high levels of free cash flow after all the demands of the business on cash are taken out, then that's one of the strongest drivers of long-term share performance. And there are a few stocks that fit into that category. So I'm by no means pessimistic or cautious on those sort of stocks at all. I think there's some tremendous opportunities in the Australian market if you know where to look. Now, precious metals, gold was up by $11 to 12.04. It did outperform the US dollar a bit, and I guess that reflects a bit of fear coming in because of the bond prices. Precious metal stocks, global majors still struggling. Australian gold stocks far superior, and we're seeing some really nice trends in some of the Australian gold producers. And frankly, they're still good value, even though they've trended very strongly. Their growth rates are comfortably in excess of their PE ratios. So I'm quite positive on Australian gold producers. Other commodities, copper didn't change much. The fundamentals around supply and demand are favourable, and I think what has played out particularly in the base metals markets is that the futures market started speculating that global growth was going to really take a hit because of the trade tariff situation, and as a consequence of that, they got sold down in the futures market. But that really wasn't a reflection of the fundamentals, and we've seen base metals prices starting to steady. And I covered this last week in Portfolio Analyst, and I even went through and showed the inventory levels in the London Metals Exchange warehouse and how that really is highly supportive of prices. Crude oil gained to 74.35. It actually got to 76 at one stage, and we've now had a break above a recent peak, so clearly crude oil is heading higher. There's the copper spot copper chart on a 6-month basis. Here's crude oil on a 3-month basis, so you can see we spiked up above 76 before we eased at the end of the week. And let's just take a wider view. So we'll look at a 1-year view just to give you a bit more clarity around that. So we had clearly a range set up here between 64 and 70, 71, and then we broke out in the latter half of September above that prior level, and we've moved very nicely over the last 2.5 to 3 weeks on crude oil. So to wrap it up, as opposed to what we're reading a lot of in the press, a bit of fear and doom and gloom, I see this as just a normal adjustment period that had to happen. I wrote last week that US indices were short-term overbought, but the pullback should be quite mild, and that's what I continue to expect. It's quite possible, however, that there'll be a bit more downside yet. Now, Portfolio Analyst this week, my predominant theme, as I said earlier, is around identifying high growth companies, but ones that are still on low PEG ratios, where the PE ratio is significantly less than the growth rate. And I've found another local stock. There's been a succession of these in recent weeks, but I've found another local stock that's absolutely poised to take off. And one that I've got very strong expectations for over the next year or two. So that's it for this week. There's my contact details, and of course you'll find a link if you wish to join the $1 free trial on Portfolio Analyst. And just a reminder for anyone that perhaps hasn't seen the video in the last week or two, with the Portfolio Analyst trial, originally we only had a a facility using PayPal, but now we've provided a facility using credit cards as well. So you've got all the options at your disposal there. That's it for this week. Cheers.